time. And essentially, I guess the first thing is, like she said, whether you're buying it for yourself to live in as your first property, or you're buying it for, an investment for rental income, honestly speaking, as long as it's related to property and you've put money in it, you're an investor. So I think that's sort of the first message that I want people to have in their mind. And as we go through the presentation, hopefully it will resound as such. And if there are any questions, like she said, just, we'll take them after. So this is the real estate portfolio approach. It's a presentation that I gave about last week. So this is the shorter version of that. And the purpose of that presentation is much like this one, which is basically to show people how they can go from whether they have none now or just one, and how they can grow that into a portfolio that is very diverse. So just in a nutshell, it's for anybody who's ever wondered, how do I actually enter the GTA real estate market with less confusion and in less time? But I should also sort of make a correction here in that what we're going to talk about today are really more broad-based strategies, whether it's GTA or Calgary or wherever it is. If it's investment and it's for real estate, money works the same way, honestly, regardless of location. So just wanted to make that little tweak. So about me, she's already covered it, so I'm not gonna spend too much time on it. I am on LinkedIn if you're really that interested, which I hope you're not on that side anyway. If you're interested in more of the strategy services for my investment services, please DM me, or I'm sure I'll share my contact information after this. So my one message that I would like to share today is that there is an efficient way to prepare for and enter the real estate market in a way that you're basically going to be achieving portfolio success. And it's not something that is completely outside of, possibility. As you've probably seen in the news a lot, it's becoming more of a, it's becoming more possible for more people from different walks of life. So I thought we would first talk about an efficient preparation that will get us to that point, which essentially is broken down to a 4-problem, 1 solution framework. And we'll talk a little bit about the optimal buying process and the optimal investing process. And then when we talk about success.
Sorry, I think you're not sharing your screen yet. So
oh my gosh.
Yeah, that's okay.
The other day as well. Thank you so much for reminding me.
No worries.
I don't know why I keep doing this. Okay. I'm hoarding my information. I apologize. There we are. So just to define what success is basically, I'm just going to minimize where it's showing me everybody's. Thank you. So success is essentially, how do you start and enter? And as long as you're thinking of a portfolio, which is for every single purchase, you're not thinking about just that purchase alone. You're thinking about what comes after that. I always say that your very first purchase is actually, or your very current purchase is actually the biggest determinant of what your next 2 or 3 properties are going to look like. And we'll see what I mean by that as we go on. Slides are a little bit slow. I don't know why. Okay. So we'll define a little bit of what the real estate portfolio approach is. I promise it's not just a bunch of nice words to make it look more important than what it is. So the real estate portfolio approach is essentially that there are lots of different ways. If you attend webinars right now, or you see all over Instagram, you tend to see follow this BRRR strategy, or use 20% down to find your first property, or buy your property with no money down. The point is, when you go on those pages or visit those people, it tends to be just one singular message. And I really want to debunk that right now to help you see that there are at least 5 different cash sources and 7 different paths to ownership. So even just combining between each of the cash sources and the 7 paths, you start to see that there are lots of different ways, and all of it comes down to what you're comfortable with and what fits your current situation at this moment. And that's also not to say that what you use now won't be relevant for your next, 3rd or 4th property as well. So it's not finite in that sense. The second thing I wanted to mention is that it's really not for the super rich. It's honestly just for the aware. If you're aware of it and you have it in your mind, it then all of a sudden becomes possible to actually achieve. And the third thing is that the portfolio approach is really about leverage and multiplying. And what that means is, in your current holdings, even if it's just the one, there is something in there. There is the value in the property that you can actually extract and leverage to then get your next one or your next two sometimes at the same time. And essentially, just to wrap it up, it's that this is you now, you achieve your next goal, and then from there, if you're always thinking about a portfolio, it won't take you a long time to actually get there. So I thought we would start by debunking some myths, because I think it's a good way to just sort of free the mind and allow the message to really sink in properly. The first is recession. The factors of recession aren't too many, to be honest. The first is if there's all of a sudden no demand for property or for anything really, then you can say that there's a recession. Or flip side, if there's just way too much supply, then you can say that there's also recession, because essentially what that means is the way demand and supply intersect, right? That is what determines price. If demand is so low that there is no interest, all of a sudden value goes down. When value goes down, that's what we call bubbles and things bursting and problems occurring. People need to file bankruptcy. Flip side as well, if there's too much supply, essentially there is nothing to really, if there's too much supply, people aren't going to bid with price, bid with money, right? So bidding is also a factor of what actually increases value, because a lot more people want something that's scarce, right? So scarcity is the fundamental of economics. So if you just kind of step away a little bit and just ask yourself, well, look at the population of Canada. What is the housing stock? I'm sure there's, I don't know what about the situation in Calgary, but in Toronto, at any given time, there's never more than like a month maximum, a month and a half worth of property. And what that means is that in a month and a half, any inventory that's available gets sold. And there is no way everybody who needs a place to either rent or a place to live in to buy can, be met in that month and a half. So that sort of debunks the recession. And also adjusted value. So what happened earlier in the GTA market from January to about the middle of March, before Corona hit, was prices were skyrocketing. So naturally, when Corona hit and there was a little bit less of movement, there was obviously a bit more fear and speculation, prices came down a little bit. It didn't cause a bubble, prices just adjusted downward. If that didn't happen, that would have caused a bubble, right? So as long as there's adjustment and the market is following just basic economic principles, that's how you start to see, okay, you know what? It might be a pause, it might be a slowdown, but it's not like a recession where I'm gonna sell everything or hide, or just that kind of sort of emotional or irrational reaction to whatever is happening in the market at the time. And the other thing is, just generally bad government interventions. If mortgages are becoming super easy, if government isn't reacting, if there's just too much household debt, those are the factors of recession. So I want to spend a little bit of time on recessions, particularly because immediately prices start to go down. That's the first concern. So I just wanted to let everybody know that is not the case. Okay, next item is price. A lot of people ask, and please, I hope you guys aren't going to ask me. So how much is a condo in Toronto? It's not that it's not relevant, but the more important thing is, why do you care? Like, how does that information affect the decision you're really about to make? Is that even the first thing you should be asking yourself as you start to figure out how you should actually be entering the market? Price is relevant, of course, but there's usually a slew of other things that you need to first figure out. And rather, instead of focusing on price, we should start to think about where value fits in. And we'll talk about value a little bit in a second. The other thing is, people assume they don't use a realtor, at least on the buyer side, it means that they're going to be saving money. That's not true. Again, because the selling price of a property is usually where the commission comes from. So it's really on the seller side and the seller's agent that they determine the price. If the seller is using an agent, it doesn't make sense for you on the buyer side to not use an agent as well, unless you're buying directly from the owner of the property, because a realtor does much more than just list a property and find a property. Like, they help with paperwork, they help with conditions, and the contracts can be quite they can get quite unique and quite nuanced based on what you're buying, especially if you're an investor and you're looking to buy, more rundown properties so you can then, renovate and get some value from it. Because if they're having an expert basically on their side helping them, then it doesn't make sense for you to not do that as well, especially if you're not going to be paying out of pocket. The price is the price. It's up to the seller to take out whatever it is to pay whomever they're using. So just wanted to clear that up real quick. And the last thing is that there is no such thing as a perfect time to buy. The only important thing is for you to understand your situation at any given time and to make sure that your portfolio has enough liquidity for you to pounce on opportunities or has enough buffer for you to be able to withstand shocks. So there's no perfect time to buy. There's no perfect time to sell. If you have the right strategy, the timing will always kind of suit you in one way or another. So just to start focusing on strategy rather than timing. So instead of all of those myths, I'd like us to focus rather, instead of price, to focus on value. And value helps us to then understand future worth. Value is really about, the rights to something. It's not so much that, if I dismantle this house or this property, I can sell the glass for this. It's not like a car in that sense where you can sell it for parts. And the more important thing is when a property is against your name, you're able to capture the future value today. So if something is going to be worth, 700,000 in future, the bank, for instance, can actually appraise that property right now, understanding of what the future value is going to be, and then actually give you money based on that. So they're giving you money based on the appreciation that's happened already before anybody has even paid you that money, which is one aspect of future value. And also understanding that this property, if it's in a good area, is going to continue to grow. So you can start to capture some of that value today. And that's why it's more important to focus on what is the growth rate of this property? What is its intrinsic value? And how can I start to capture that? How can I start to plan for that? So forget about price. Even if you buy something for 300,000, if it's not growing at a good rate, or if it's growing at a better rate than something that you buy at 1 million, you're in actually a much better situation. So I suppose building up on that is the notion of estate and property. So property is something that, you can hold, is tangible. Estate is really just what are the different combinations of that future value, right? How can I take maybe my rights to this condo, use it to leverage, or join it with my rights to my multiplex, and then combine all of those to do something else in future. So that's really the concept of estate, which is really why people fight over property, like inheritance and all that. This is why it matters, because it's not so much about what the property can do. Land is just land. If you don't develop it, it means nothing. But when it is developed, what you can then convert it into is an estate, which is a multiple rights all sort of commingling together to really open up your opportunities. So start to think about estates. So what to do where you are right now. To do that, to discuss that, I thought we would just assume that we're all first timers in one way or another. Maybe we don't have our first home that we're living in as a principal resident, or we just have that one property, and then becoming an owner, and then how we can leverage what we have in our current situation to become sort of fuller fledged investors, like how you think about investors. Somebody has 2 or 3 properties or more. And then we'll talk a little bit about investment clubs as well. So for first timers, the very first thing is to really understand your financial boundaries. How much do you have, whether it's savings, whether it's, buying with family members, how much do you have around you? How much can you leverage? There's a saying that your network is your net worth, right? So you and 5 friends, for instance, and that's the beauty of real estate, because there is so much growth opportunity on the back end. Literally, even if 10 of you got together to do something, it's so much more than if, you individually just, played the stock market, for instance, right? So set financial boundaries, understand all of the opportunity around you in terms of who you can leverage and where you can leverage it from. Your RRSP, for instance, there are a few government programs that we might discuss later. When you combine those things, how much do you have? Once you set that upper limit, do not exceed it, especially for investors, because if you start to exceed it, then you start to mess with your rental income potential. And essentially, you're not making money, and then you have to look at, outside of the asset to sustain it. And by the time you're doing that, an asset all of a sudden becomes a liability, and that's just not a good place to be. That's when panic sets in, and that's just not a good place to be. The second thing after you set your financial boundaries is to then ask the question, well, what can this get me? And I will say here, especially if you're just starting, to not be afraid to start small. I like to give the example of the first condo I bought. I bought it for like 360 or something. 3 years in, it's about 615,000. And so a tiny, tiny property in terms of value in some obscure town in Oakville that's just, not very well developed, that area. It's coming up now, but in 3 years, it's grown by that much. And so it's a small property. You don't need to start with something that's 1.5 million, right? Starting small sometimes is better because you can learn your mistakes and all of that. And also, when talking about property opportunities, just because everybody's flipping or everybody's doing multiplexes, don't start there, because for the bigger, more sophisticated opportunities, you need bigger teams. And if it's just you starting, trying to figure out what it really means to invest, if you bite, more than you can chew, essentially, you're already going to be at a loss. That's just facts. So once you've set up those first two steps, and that is really the bulk of the work, that's really where the strategy is. And we'll talk about what feeds into that strategy in a second. Once you figure those two out, then really the rest of the process is just very basic. You've seen your property options, you've selected the one you want, you make the offer is accepted, you do your due diligence. So usually offers are made conditioned on like a home inspection or some other kind of due diligence, making sure, the survey, the property rights are as registered on title and things like that. And then you close on the property, which is basically give them the balance, whether you're using a mortgage for that or you're going to be using a joint venture for that. Just basically pay for it. The title of the property becomes in your name. And then what I like to do is immediately figure out what really the next steps are supposed to be. Just because, you've closed in your first one, I mean, unless you're the kind of person that you just want to stay there and you're not really interested in growing a portfolio, which would be a waste. Immediately you've had your little glass of champagne, you're happy, you've toasted to yourself, yay. The very next thing is to start to figure out, what can I do with it? If not, essentially you're not going to be planning for the future, and that's never a good thing. So we talked about some paths to ownership and cash sources earlier. So the first one is, a landlord buyout. Just very simply, you can either use this as, there's a landlord who has a bunch of tenants in there right now. You essentially buy that with the tenants, and that becomes immediately an income generating opportunity. This is good if you don't really need renovations for that property. Or on the flip side of that, if you're currently renting and you like the place, you essentially just strike up a deal with your landlord and say, you know what, I want to buy you out. Here's some cash. You can, avoid realtors, avoid commission. It'll be a lower price, hopefully. And, there you have it. Rent to own is similar. Rent and own is really for people who have a little bit more loose cash. And, get a bunch of friends together, stay where you're renting, get a bunch of friends together, and basically start your portfolio for ownership. Pre-construction, as the name suggests, there's no actual property yet, but you've basically put down your deposit and it's going to be yours when it's done being constructed. Assignment basically means that, let's say somebody has already bought something but they aren't able to close on the property. They essentially say, you know what, why don't you pay me whatever I've already put in the property, and then the property becomes yours, and then you will carry on the rest of the obligation, whether it's to the developer, or basically you're buying somebody out for a resale. And assignment really sort of highlights what I mean by the rights to a property. So imagine somebody that, for instance, in the pre-construction, there is literally nothing. It's literally just land. But just because they've put money down and said that whatever is going to be there eventually is theirs, or they want it to be theirs, and they've put money down towards that, they can actually trade that already, whether or not there's actually property. So there's actually no physical thing, but they're already able to trade something and even make a little bit of a profit on it. So that really starts to properly capture what I mean by rights over property and estate over property always. So 7 cash sources. This is the home buyers program. Essentially, you take your RRSP to buy something. First time incentive, government will give you, anywhere from 5 to 10% of the property's value. And you can really use that for, like, when it comes to crunch time, like, you need maybe a couple extra grand for, closing the property, or you're just shy of your down payment. So that's a really great way. And for that, government essentially owns a little bit of equity in the property. And when you sell it, you give them back. But again, if you use my example, for instance, 10% of 615,000, you sell it, I mean, that's 60K, and you have still like 300 and something K to your name. So, there's really no loss. Insured mortgage is essentially when you put down less than 20%. So if you put down 5% or whatever it is, you pay a little bit of a premium. Co-living is essentially, you and a bunch of friends. It's sort of leading up to an investment club. But for investment clubs, you don't have to cohabit. You don't have to inhabit the property. Inheritance kind of works like a gift. So essentially, say mom, dad, or auntie, uncle, whoever it is, I love you, but I'm not hoping for you to die, but please give me the property. Or rather, give me the money now so I can buy property. And essentially also buying with your parents. I actually heard, sorry, I'm going to take a little bit of time on this, but a really cool story that I heard. I didn't work with this person, but they told me about it, where, their parents were looking to downsize. His sister had moved out. He's fresh out of college, maybe just like 2 years working experience. And essentially, him and his parents bought the property. So they put down the down payment, and he's going to be making the mortgage payments. But the rate that they used, the credit that they used, was his parents. So he got in at the lowest possible rate for the mortgage. And essentially, they're basically going to just gift it to him, or he can buy them out. And he's basically starting to accrue wealth, and he didn't really have to he hasn't used his RRSP. He didn't have to come out of pocket for savings, none of that. So it's a really great opportunity if you guys are in the positions to do that. So yeah, current owners, you can also leverage some of those cash sources that we talked about in passive ownership. And essentially the idea is, why start with, or why sell your current property that you're living in only to buy a bigger one? When if you sold the current property you're living in, bought something that was maybe the same size, and then use the balance to buy a pre-construction, for instance, right? And on and on and on it goes. Maybe by the time you get to your second or third year of investing, you can sell 2 of the pre-constructions and then, buy a multiplex. So a multiplex is 3 or 4 families living in the same building, and essentially you're able to hedge. So if one of them was not able to pay rent, you have 2 or 3 other people paying rent. And so maybe, at the end of every month, you're getting like $1,000, right? So that's perfect. And this is what they say, use your assets to pay for your lifestyle. So this is sort of the dream. And then from here, you can start to think about commercial, small plazas, things like that. And a lot of current homeowners, what they usually use to start that is refinancing. And so refinancing, this is just sort of high level, the simple math. You basically take your current property and you go to the bank and tell them you want to refinance, and they will appraise it. So an appraisal is going to be, the value they appraise it at is going to be a little less than the market value, but it's still usually, so much more than what you've bought it at if you bought in a good market. And essentially, they take your same loan to value ratio. So if they gave you an 80% loan before, they would use that same 80% loan to look at the current value, the current appraised value. And that essentially is the maximum that you can take out. So you take that gross figure out, and then they deduct your outstanding balance for your current mortgage. And then, basically what you're left with, maybe 100K, 150K, you're able to use that to start your investment. The only thing with refinance is essentially you're going to be starting a new loan agreement. But again, you're not selling that asset. That asset is going to continue to grow again. So if the appraised value, let's say you bought it at 400, the appraised value is 600, right? You do the math, you get up maybe your 120,000 or whatever it is. When they do your mortgage and you're looking at your future growth, it's not going to be from 400 again, it's from 600. So that is to show you that even if you take equity out of property, it's still growing. Like it literally never dies. It only dies in your hand if you sell it, right? So don't sell, and also don't pay off your mortgage. It's a waste of time. So investors, as you start to have 3 or 4 properties in your portfolio, essentially you always have to be checking, is your portfolio strong? Is your portfolio deep? And strength essentially means you're able to withstand shocks, you have liquidity, you're comparing growth rates, and your after-tax income on a monthly basis, very important, has a buffer, right? Anything, for me, my rule of thumb is if it's less than $250 per month after I've taken out tax, maintenance, all of that, even income tax, personal income tax. Once I've taken that out, if it's less than 250, I don't like it so much, right? So you need to be careful of that. And depth. So depth means, in 3 or 4 years from now, do you have a strong asset base that if you sold one, you can use that to get three, right? So is your portfolio deep? Are the roots deep? Do you always have something that you can leverage and trade for the future? Um, Jen, just if I'm taking too long, time check me. We're near the end, I promise. So the next bit is creating a club. So clubs can be really interesting, and they can also be companies. So if you incorporate it, it's a company. If you just register it at a club with CRA, then it's just a club. So you basically have to figure out if it's the right time for you. It sort of allows you a lot more flexibility in terms of, tax, incorporating. It essentially becomes its own small business. So there are definitely pros to it. But on the cons, it's more, you need a bit of administrative skill, right? So you're going to need a club secretary. You're going to need to determine the number of members you want in your club. You're going to basically have to figure out pretty early on the kind of property categories and the types and the locations and all of that, because it's really the best way to capture all of those in the agreement before you even start the club. Because the worst thing that will happen is, 3, 4 properties in, or 3, 4 years in, maybe a dispute comes along and then it becomes an issue of he said, she said. So having that agreement, determining all of these factors, entry, exit strategies, who can come in, when can they leave, how to use the proceeds, all of that, items you should definitely be considering and putting into an agreement before you go forward. So to really help to convert all of the things we've talked about, what I've realized is that most people get stuck in what I'm calling the four problem frame in the four problems, and there's usually just the one solution to address all of that. And that's really what I'm calling the real next step that you need to take. So the next step you need to take, of course, figure out your financial boundaries, but to really even determine, I suppose, your mindsets and understanding, who are your networks, is really to first figure out this next few things. This is why I'm calling them the real next steps. So the first is, why do you really want to buy something? Are you buying it just because first run now, immediately, you just need something to live in? Are you buying it so I have some cash, I just want to hold it? Do you know immediately you want to, in 5 years, own a commercial asset? Because all of that impacts how you start. Because if you don't start properly, it makes it a little bit more difficult as you go on to, adjust. The second thing is awareness. Do you understand which properties around you will be able to get you to where you need to be? Do you understand which of the government programs? Do you understand which of the strategies that we mentioned you can combine to really, again, get to your desired goals? And resources, very, very important. Cash is one thing, like I said earlier. Your network is your net worth. Even how you play with debt and equity, because debt is not the same thing as equity. Debt doesn't require as much payback as equity does. And at the same time, equity can be harder to get or easier to get depending on your situation, right? So really understanding your resources and how they complement your goals is really critical. And the fourth is really sort of the crux of all of that, is how do you even combine all of these things? So like, yes, I know I want commercial properties in the future. I'm thinking if I buy 2 or 3 condos in the immediate term, but which leverages can I leverage? So which resources can I leverage? All of that requires skill. So you need a realtor, you need, probably somebody who does property management. You yourself need to be able to understand like investment analysis, right? So in lieu of that, what can you do in the meantime? So just wanted to, I might not even really cover this. Sorry, Jen, I feel like we're a little bit
Um,
over.
yeah, just a little, maybe about 3 more minutes, and
3
then
more
we
minutes,
right
perfect.
in. Yeah.
So just real quick, if you're feeling stranded right now, this is sort of your typical process, right? You're trying to get a realtor, if you're ready to transact, great, you close the deal, but you don't really understand what next. And I think that's often the problem, right? You struggle, you get the first one, but then what do you do next? And that's where it's usually hard to create a portfolio. Or you're not ready, and then basically, you end up on some email list, but you don't really have a solution to actually move the needle in your situation, right? So it's not just that, yes, you're probably searching in the wrong places, but at the same time, it's not really a system that's really efficient. So, my real estate portfolio approach is really combining all of the 4 questions at the same time, answering them using skill as the lever to be able to answer them at the same time, is what I'm calling the one solution, beginning with skill. And hopefully when we do that, we're able to convert to, portfolio approach that first starts with a mindset of efficacy, and then you understand what is really possible in your situation. And this is not a one-time thing. Like, you're going to be constantly asking yourself these questions always before you take your next step. And then basically you can map out your real estate journey, and then that way, you know exactly what to do, and then you create your financial health, and basically you're good to go. And wait. All right. So I actually have a lot more to talk about. So maybe what I'm thinking is I'll just maybe share some of these later with Jen, and then she can share around. But essentially,
Yeah.
real estate is not impossible, but it's also not passive. It's not like stocks until you get to maybe a big club with a lot of team members that can manage it for you. But it's definitely not something, you do with your eyes shut. It's definitely fun. It's definitely interesting, but it might not be for everybody. So for sure, it requires discipline. And so this is just a quick summary of your investment process. I actually have a downloadable that I'm going to share with you guys after as well.
Okay, that'll be
And
awesome.
basically my whole thing is working with people wearing 2 hats. The first hat I wear is as a strategist. So you and I won't have to sign an agreement, to say I want to buy something. And if you're not in Ontario, we can still work on that strategy level to really understand, what is your need based on where you are right now, whether it's a phone call, putting a strategy together, coaching you through it. And then if you are in Ontario, we can then get to the point of, okay, I want to use Mutiat as a realtor, or work with any other realtor. Because by the time this is over, this is really the bulk of the work. You've answered the 4 questions, you know what's happening. And then whether or not, your realtor gives you your own medium-term portfolio, you can create it on your own, because again, you'll be armed with so much knowledge, working with me as a strategist to be able to basically figure out what to do next. And so that's it. That's where I am in all my places. And it's probably just easiest to find me on IG. And DM me, and basically, yeah, that's it.
Awesome. Thank
Sorry
you
if I
so much, Mel. Oh
fast.
no, that's fine. I think you were right on, because we did talk earlier and you said you're gonna give yourself about 30, 35 minutes. I think that was actually spot on.
Yay.
So we do have a few questions that have come
Yes.
in. And I'm gonna try to take as many as we can, because I'm really trying to stick with the 1 hour. But if we can't, then I guess if you can share your contact information, and then people can reach out to
Sure,
you
sure, sure. Yeah.
directly. Okay, so the first question we have here is, when it comes to having a value versus price approach, what factors should we be looking at to help us determine whether a property has good growth potential?
Great. That's actually, first of all, you were listening. I really love that question. So the very first thing that I check is growth rate. And I think the best way to capture this is to tell a story. So I had a colleague, actually, he had a client. So my colleague had a client, long story, who basically bought a property in Oshawa that they were living in. Oshawa is it's a quieter neighborhood in the east side of Toronto. So they bought their primary residence, and they bought their investment property in the same town. Primary residence is probably growing at about 2%. Investment property is growing at the same, 2.5, 3, whatever, 5%. 3 years down the line, they wanted to sell both of those, and or rather 2 years down the line, they wanted to move to somewhere else. Even if they sold both of those at those growth rates, with the money they got out, they weren't able to even close on one property in the next town that they wanted to buy in. So the biggest issue that was clear in that situation is that they were led by price. They were led by, this is cheap and I have a little bit of cash, let me just put it in. They didn't ask themselves, what is the growth rate in this area that I'm currently buying? And then what is the growth rate of the area that I'm even thinking to go buy next? So if your growth rates aren't matching, it's highly unlikely that you're going to be able to move upwards. And that's generally how it is for all of us. Like, knock wood, we're in good jobs, we're saving, we're doing all the right things. Naturally, we're going to be upwardly mobile. So you can't really make a decision that you're locking yourself into your current situation without thinking, the next place I want to move to is Vancouver. I'm not going to buy something in Oakville that's giving me anything less than 17% returns because I know Vancouver prices are high, right? So first of all, look at the growth rates of where next you want to be. The other thing you can look at from an investor perspective is, like I mentioned earlier, your rental income. So my rule of thumb is anything from 0 to 250. 250 is sort of like the minimum every month that I feel like a property should be giving me. If it's not able to give me that, then that probably means that it's probably just not in a good area. If I'm not really able to capture more value that would give me enough rental income. Or on the flip side, how much value did I give up by my financing structure? Did I take on too much debt? Could I have paid a little bit more equity, right? Did I just look at terrible terms when I was doing my loan? And if I use private financing, then that can be, a little bit more dangerous as well. So what are the things that can eat into your values? Don't just look at the price that you're entering the property at. How can it grow over time?
Awesome. I'm gonna give that person A for actually being an attentive listener. Okay, so the second question we have is, why do you think paying off your mortgage is a waste of time? Could you please explain further?
Yes. So the average mortgage term is 30 years, and so 30 years, you're paying like $1,000 or 1,200, 1,500 a month, right? If you wanted to fast track that to pay off your mortgage in 7 years, just simple math, multiply that by 7. So even if you're crazy rich, you're going to be giving away $7,000 or $8,000 a month. When the opportunity cost is, if you're only paying that 1,000 in that same month, you can actually have invested in 7 different properties. So when you look at opportunity cost is, if I'm putting all of my eggs in one basket, what are the other baskets that I'm ignoring? It's either you rush to pay off your mortgage early, or you take all of the 30 years to pay off your mortgage, in which case it's the same thing. Why would you pay off one property for 30 years? And when will you start the second property? Do you understand? Like most of us are going to probably die by, okay, fine, 100. So you're only going to own 3 properties in your life, right? And that's assuming that prices are static. Prices are not static. Value is not static, right? So it's really, so that's on the one hand of the arithmetic of it. On the second hand is, on your average mortgage payment, your 1,200, your 1,800, about 40% of that goes to paying off the bank as interest for the money they borrowed you. The remaining 60% actually is accruing back to you, right? So like just as a rough example, you take 300,000 as a loan, you're paying 1,200 a month. If you check in your app, in your TD app or whatever it is, you actually see the loan amount reducing. Each reduction in that loan amount is actually accruing back to you. So you don't need to wait to take that money back out again to pay it off. So if you're waiting to pay off your mortgage in 30 years, thinking that you can now take the bulk of that money to buy something with it, you don't need to. Where you are right now in that moment, that's still going back to the issue of, looking at property as bricks and mortar versus the rights. You immediately own the rights to the equity that you're putting back. Take it out. It doesn't need to be there. And then also just time value of money. Money today isn't the same as money tomorrow. So if you think that you're going to pay off your 300,000 today and think 300,000 is probably going to be worth, like, I don't know, if we're great, what's the inflation rate? Maybe 150, like, in like 10, 15 years. Like, that's just, so it's today. Please use your money.
Awesome. Okay, so this one is, okay, so could you expand on not selling? Okay, I think that's kind of what you just touched on. Any tips or suggestions on how to get into commercial real estate market? What metrics or indicators do we look at to measure or project growth in an asset or your portfolio?
Right. So commercial real estate is a whole other kettle of fish. It's not treated at all like residential. So the very first thing with commercial is obviously their rent roll. So rent roll is basically who are the people that are currently leasing the properties, not just the amount that they're able to pay or the amount that they're able to make every month, But what we've learned with this lockdown is if you're not an essential service or you don't have a commercial property with a blend of essential services,
Mm-hmm.
it's a wrap,
Yeah.
right? So, we need to start thinking about commercial properties in a slightly different way. There are commercial properties that can have light industrial things, right? So that can have, and so maybe this can even start to, like in Hamilton, for instance, they're starting to do a lot of things where some light manufacturing can start to come back, some co-working spaces, and not just everything else is a retail shop, right? Because retail shop is likely to go, combust really after
Mm-hmm.
COVID returns, right? So I would say the first two things are how much every month are they able to make, per square foot, all of that. That's really critical. What is the maintenance per square foot? What's the operating, expense? If you're I mean, as an accountant, you probably, expand on this, but if your operating expense is starting to eat too much into your net income on a monthly basis per ratio, definitely not a good look.
Mm-hmm.
So basically, based on your capitalization rate and how much it is that you want to earn every year, you essentially work backwards. So if you want to earn 7% every year, just work backwards. What net income are you going to need to have on a monthly basis to achieve that? And then who are the people in the property that are going to be doing that or leasing the property to be able to help you get that? Co-working spaces could be great because once COVID is done, we're not going to be working in offices anymore,
Yeah,
right? We're going to be
that's so
getting
true.
small suburban co-working spaces. So even though a few of them, yeah, they're shut down now, they're going to be very quick to open, right? So that's the kind of sort of hedging when we're talking about a strong portfolio and a deep portfolio. Those are the kinds of things.
Okay, awesome. I have a question here as well. When you refinance your property, I think this is more of a personal one, but when you refinance your property, say you bought at 400K and you refinance at 600 because of increase in value, does your mortgage payment increase?
No, so what you're doing is you're actually renegotiating the term. So let's say right now you're paying, 2.5%. In that 5-year period, they will look at your income again and they will look at who you are. Are you paying your debt? Just all of those things. You haven't going to accumulate any more debt. So it's almost like they relook at your profile again, and then they will sort of redetermine what new rate it's going to be. Now that new rate could very well be the same or even lower if all of a sudden, you left your risky job and now have a more secure job, right? Like you're no longer on probation in your workplace. So they're just looking at your personal finance situation again. It might not increase as long as you're not refinancing, like in COVID time, for instance. Nobody's going to answer you really trying to refinance in COVID time if you're not a doctor, right? So it doesn't always mean bad news, essentially, but you do have to make sure that your whatever number they give you still fits within your personal finance.
Okay. And then I think final question here is, would you ever advise against refinancing a home mortgage in order to buy a rental property? Why or why not?
Oh, I would never argue against that. That's what you're supposed to do. Absolutely. Because think about the struggle to get your first property. Where are you going to find that money again? Right? Like so yeah, sure. If you have aunties, you have uncles, you have friends, you can create a network, but still that bulk of money is going to come from somewhere. The property you're sitting on is the goose that will keep laying the golden egg for you. So if you're looking from that perspective, as long as you're not over leveraging, and as long as you're not then using that money to buy into a rental property that you don't understand, right? In a market that the growth rate isn't good. If your mortgage is, for instance, 2.5%, but you want to go buy a rental property in a market that you don't understand, but when it comes down to it, is also growing at, 2%. You've wasted
Right.
your money, right? So this is why looking at what the future opportunity for whatever it is that you're looking to buy into, really, really critical.
Okay. And then I think you touched on something about understanding the market. So would you advise, or I guess, what are your thoughts on investing in an area that you do not currently reside in? So for instance, I live in Calgary. Would you advise against investing in property in Toronto, for instance, even if I know that I'm never going to move to Toronto?
Absolutely not. And this is what I meant by skill. So when you understand the broader market around you, you're aware, right? You
Mm-hmm.
ask the right questions, you understand your resources, you understand that, I want to invest. This goes back to the why question. you want to invest for a broad and hedged portfolio. It's not like, you really care who's in that property. You just want the property to grow. So if that's the level, probably invest in Mexico. All you would need is the right skill. So skill goes back to who do you know in that market, right? That can help you. Do you have a property manager? Do you have a service provider that provides end-to-end services that can actually help you to convert, your money or your resources into a proper long-term, asset earning strategy for your portfolio? So classic example, I'm working with a client now who he did a flip. Oh no, he has it, not a flip. He has a duplex in Winnipeg, and he's new to Ontario. And they did it with a joint venture structure, and he actually wants to do that again in Ontario. Of course, he goes, look, I don't know the Ontario market. I'm hearing about Cambridge. I'm hearing about all these different places. Can you help me run the numbers? Can we go together, right? So he's been here for like 6 months. I mean, he's moving here, but he doesn't know about this place at all, right? So that's sort of, as long as you have the right skilled people beside you, you can really invest anywhere.
Okay.
But it's
So
critical
definitely,
to have the right people.
right.
Yeah.
Okay. Okay, so final question then. In your opinion, would you pay down your debt or invest in something for extra income?
It depends. So your personal finance gurus might vex for me a little bit, but for me, it goes back to opportunity cost, right? So the first thing is, what is your debt preventing you from doing? There is a certain level of debt that if you go above it, all your opportunities are cut off because of something called the debt service ratio. Because when they look at your income, whatever you're coming in can't even pay the current debt, much less pay any other debt. So if you know what that number is, go below that number. Once you go below that number, other opportunities are now open to you. What you then need to be really careful about is that what you're investing in, instead of paying off your debt, is not going to represent a loss. And you're not going to be incurring more debt from that. So if you've paid down your debt to a comfortable debt service ratio where maybe private lenders or banks or whoever will give you money, you've gotten to that point, don't then go and invest in a market you don't know or a property that you're going to need to rehab and you don't know. Look, me, if somebody tells me to go and buy like a rehab property and I don't have a contractor, I'm not even going to start. Like literally, I might as well just say, just here, take my cash, because I don't do DIY, period. Like I don't even, like to clean my condo. It's terrible. But so imagine knowing myself like this and I say, oh, a bunch of people are owning multiplexes. I too want to go own a multiplex. So instead of paying down your debt, you've actually put yourself in a risky situation that represents essentially future bankruptcy. So I'm not going to ever say pay off your debt. A certain level of debt in a capitalist society is, in fact, if you don't have debt, they probably look at you like you're crazy a little bit. So debt is not bad. It's only bad if it's like credit cards, you over leveraged your home or whatever it is.
Right.
As long as you're servicing it, they don't even care, because they remember your debt, your liability is their asset. So why would you give all of your assets to them? Like, or why would they want you to pay it off? Essentially, you're no longer a business to them. So use that to your advantage. Just meet the minimum criteria and then just begin your investments. And as your investments grow, you pay off the debt where you're comfortable and you take on bigger debt, but it's productive debt. And then it doesn't matter.
Right. So then I guess the key point there is that it has to be good debt, not like high interest credit card or
no.
debt
Two
yeah.
It has to be good debt. Good debt is productive debt, and productivity means that whatever you're getting out of it is more than what the cost is. Right. And the second thing is, if you do need to pay off debt in advance, what is your debt service coverage ratio? In simple terms, it's when you look at all the things you have to pay off, if you all of a sudden lost half your income or whatever it is, can you still meet those obligations and have a little bit of money to live on? If the answer is yes, just get to that point of debt and then you're good to go.
Awesome. Okay, so I lied before. So final question.
No, I can keep going, man. So final. I'm good. We can stay for as long. There's a
yeah.
So
I guess this one is more for investing in like rental property investments, right? what would you advise between short-term rentals versus long-term rentals? So like Airbnb versus just renting it to a tenant for a longer lease term.
Yeah. So again, it depends. Some people feel like shorter term rentals, you can get more money. And so they prefer that. So if the more money, again, everything is always trade-off, right? If the more money you're getting is better than or is enough to cover like a month gap, right? Then it is what it is. Because obviously shorter term rental means there is no guarantee of recurring income.
Mm-hmm.
If you want recurring income, then clearly long-term rent is for you, right? And so a very simple way to answer that question is when you look at the depth, the strong portfolio and the depth of the portfolio. If you need a lot of cash, but you know that you have a lot of good asset base and your portfolio is deep, but you need a lot of cash, right? Right now, just do a bunch of short-term rentals, and then you're able to just get that liquidity, right, without having to like sell off a condo, for instance, or sell off
Mm-hmm.
a little bit of your asset. Because if your game is to protect your asset base, then you can do a little thing, a little bit on liquidity, because really and truly your entirety of your portfolio can withstand that kind of strategy. But so yeah, it really just depends on what your preference is.
Right.
But on the topic of Airbnb, because you asked me earlier, so I actually did a little bit of research on that.
Okay.
In Toronto, I'm not sure about your market, but in Toronto, in Ontario, so Toronto will be mainly hit because Airbnbs are in Toronto the most. There's a new rule that you can only use a property that's currently occupied by the primary resident for Airbnbs. So what was happening
Oh.
before is people were buying condos
Mm-hmm.
and using them for Airbnb. And Airbnb is different from like short-term rental. Airbnb is more like a hoteling kind of structure.
Mm-hmm.
So the shorter term rentals for like, 3 months, 4 months, 6 months, I think those are still available, but specifically for Airbnb for like people flying in a week, a month, that can't happen anymore. And the reason why that was introduced to the market is because we have a serious shortage of property here in Toronto. Like I said earlier, we only have, at one point earlier in the year, it was only like 2 weeks worth of inventory. Like 2 weeks, a property hit the market, it was gone. Properties were selling for like half a day here in like half a day. Yeah, no, it was a crazy January and February. So they're like, look, the market is overheating. This makes no sense. Let's just cut this out, and all of our properties that people are buying for Airbnb, because they think they can make a lot of money off of it, charge someone like hotel fees.
Mm-hmm.
Let's stop that. If we built this condo for people to occupy on a long-term basis, let's put it towards that. So that was that new rule. And yeah.
Okay, awesome. I think there aren't any questions. So yeah, I didn't lie. That was the last question. Thank you so, so much. Actually, thanks everyone for coming today.
Yeah, thank you guys.
Again,
Great questions, by the way. I feel like I even need to, like, can I screenshot this or can you copy them to me? These are,
yeah, I think I can save the questions actually.
yeah.
Um,
I mean, I won't copy people's names, but these are really, really, really great questions that I can use as like Q and
yeah, my audience actually pays attention. I'm proud.
Nice. I
I'm
love
proud of
it.
them.
I love it. I love it. Really.
Okay, so thanks everyone for coming. And again, Mo has left her contact information in the chat as well. So if you want to just grab that and contact her if you have any more like specific personal questions. Like I said, she's a strategist and she's a realtor, so she actually works with people to make their investments come to fruition. So thanks everyone for coming. Thanks to Mo for that amazing presentation. Please stay tuned for more. We might be doing a few more of these in coming months. And again, this has been recorded, so if you want to go back and rewatch it, I'm going to be uploading it in our YouTube channel. I'll send an email out with the link and everything. So thanks everyone,
Nice.
and I hope you
Thank
stay
you.
safe and have a wonderful weekend.
Thank you. Bye,
Bye.
guys. Bye.